Okay, so this is what? This is Madina Limited profit and loss account for year 2017 and 2018. We have what system of financial position, as you can see it over there. Now, listen to this additional information. It says that on 1st October 2017, what year? Have you seen the accounting year for the company is when? You take note of all that. Accounting year of the company is when? The accounting year is when?
30th September.
Thank you. The accounting year, 30th when? 30th September what?
18.
The accounting year of the company is 2018. You take note of that. Now watch here. Look at additional information. Say that on 1st October 2017, they acquire 100% of what net assets of what Abuabu Limited for 50 million. In order to finance a transaction, Madina Limited issued 50 million 8% loan note on what? On acquisition. You understand? So here, what do you see here? There's an acquisition of what? Of a subsidiary. And that acquisition was done when? On 1st October 2017.
2017.
Do you understand? So you take note of that. Now, at the end of the accounting year for that particular company, this is their what? Their finances as well. Their P&L, as you will see over there. At the end of the accounting year, as of what? September 2018, this is the accounting account as well. Now, Abuabu Limited has not paid any dividend during the year, but Madina has paid what? Dividend of what? 0.5 per share. Now they've given you what? Ratios. You understand? They've already given you ratios of Madina. They've already given you what? Ratios of what? Of Madina. So return on capital employed, gross margin, and on net profit before tax margin. Now calculate the equivalent ratio for Madina for 2018. Obviously, they've calculated 2017 for you. Obviously, so you should calculate the 2018. Please, have you seen it? Good. So they say we should calculate the what? Calculate the equivalent ratio for Madina Limited for 2018, including the results of what? Abuabu Limited acquiring during the year. Have you seen that this company was acquired in 2017? Do you know that? The company was acquired in 2017.
The second company
was acquired in 2017. It means that when the parent company, which is what Madina Limited, is preparing the account for 2018, they will consolidate what? Abuabu Limited. Can you see the P&L of what? The Madina Limited. Madina Limited 2018 and 2017. Have you seen it? Now, 2017 and 2018, this is the P&L of what? Of the parent company. The subsidiary was acquired in what? 2017. October 2017. In 2018, when the parent is preparing profit and loss account, don't you think that they will include the subsidiary?
Yes, they will always include the subsidiary.
They will consolidate it, right? When you look also in the words below here, you will also see that the Abuabu, the subsidiary, has also what? Prepared what? Separate account here. Have you seen it down here?
Yes, sir.
2018. So here, so you follow it that way, then you can use that one to solve the question. So here, they say that calculate for what? Calculate for 2018, including the results of Abuabu Limited during the year. So it means that 2018 here, P&L, the 2018, it includes what? The subsidiary finances. Are you aware of that?
Yes, sir.
So if you are coming to calculate, you calculate including the subsidiary. But the 2017, it was not consolidated. You know that. But 2018 is a consolidated account. So here, when you come here, how do you do it? So we say including the results of Abuabu Limited acquired during the year, right? So here, what do you do?
Yes, sir, I can see the box.
All right. So the company name is what?
Madina.
Okay, the company name is what? Madina. Okay, so the Madina Limited. You are coming to do the calculation, right? Okay, so here you have your ratios. The first one, they said we should use the already calculated ratios, right? Which is what? First one is what?
ROCE.
Return on what? Capital employed. So you have what? Full like that, right? What is the formula for return for capital employed?
Profit before interest and tax.
Profit before interest and tax. That you put it there. All right. All divided by how much?
You can use from what we have learned.
All
You can
divided by
use
what, please?
total
So you say what? Total asset
as
minus what?
minus current
Total
liability.
current what?
Is what you have taught
Liability.
me. That is it. Thank you.
So that is what you will do. How do we calculate it? So here, let us go and then find profit before tax. So in the question,
Sir,
which one is?
sir, I think it's times 100 though.
Yes, times 100. Yes. So let's go into the question and look for what? Profit before interest and tax. Have you seen it?
Yes, sir. That is the parent.
Yes. Profit before interest and tax is how much? First, I have seen it. Okay. Let's go. So you have here in the question, you have what? We have what? Profit before what? Before tax, which is how much? 800 or 8,000. Now, you say you add what? You add back finance cost. You understand? Or that's interest. Because when you look at it, they've already deducted the interest from it. Finance cost, have you seen what is what? 4,000.
4,000.
Have you seen it? You need to add it back. So that gives you what?
Yes,
when
sir.
you add it, it give you what? 12,000.
12,000.
So that gives you what? Profit.
12,000.
Profit before what? Before interest and what? And tax here.
Yes, sir.
Good. Then you come and look for what? Total asset and total liability. So here you have what? You have what? Your total what? Asset. How much is your total asset? Right. So total you have what? Your non-current asset. Total is how much? So let's go into the P&L. Your current asset. Your non-current asset. So your non-current asset. What is the total?
220,000.
Which one is that?
The net asset, non-current asset.
220,000.
Yes, sir. That gives me 38,000.
38,000. Are you sure?
Yes, sir. You can do it. In fact, I love the way you do your work. You always want to prove.
Yeah.
So you
So
can
you have
do it.
12,500 plus 6,500. How much is it?
So go to the paper, you see it. We have only two elements for non-current asset. Only two elements. I've seen it. So the total is 110,000.
Yeah, you are right. So the total current asset, non-current asset is 110.
Exactly. And then when you come to the current asset, we have the three items. The bank is nil.
Yeah, so when you add them,
so it's 19. The 19
absolutely
is correct.
So yeah. So non-current asset is what? 19,000.
Exactly.
So when you add it, it will give you how much? 129,000. Okay, so
yes, sir.
that is it. That is it about what your total current asset, your total asset. Then you come to our current. So we are done with this. So what do? We come for our what? Our profit before tax. We've also calculated that, right? We've also calculated that. So here, what do we have? Then we can what? We can do that. We can insert the formula. We can insert the values in the formula.
Sir, please, you are left with the current liability.
Yeah, okay. Let us look at current liability also. So you have your current liability. So how much is your current liability? Let's go into the question. We have our current liability.
It's 22,000.
22,000. Our current liability is 22,000.
Yes, sir.
So we have 22,000. Okay, so we are good to go. All right, we are good to go. So now we had all that we wanted to. So what do we do next? We can have our
we insert them into the formula.
Yeah, so you have your ROCE is equal to what? Profit before interest and tax, all divided by what? Your assets minus what? Your liabilities times 100. So what do we have? Profit before interest and tax is how much?
Profit before 12,000.
And then we have what? Your total asset is what? 129,000 minus what? Minus 22,000.
That will give me 107.
Okay, so what do we have?
So I had 11.2%.
Okay, 11 point. So the second one is what?
The second one, sir.
Okay. The second one is what?
Current formula is
gross profit margin. Gross profit margin. So what is the formula for gross profit margin? Formula for gross profit. Formula for gross profit margin is what? Gross profit over sales
Sales tax.
or revenue. Okay, here, what do we have? We have our gross profit. How much is our gross profit? Check it.
The gross profit is 25,000.
Gross profit is what? 25,000. We all can see it there. 25,000 all divided by sales.
Sales is 125,000.
So you have what? 25,000 divided by what?
125,000.
125,000 times what? Times 100. What do you have?
Yes, sir. So 20%, sir.
20%. Okay. So the third one is what?
The third one, sir, let me go there. Third one is net profit into bracket before tax margin.
Okay. So net profit. So net profit into bracket before what? Before tax. Okay. So what is the formula for it? So that's net profit before tax, all divided by what? By sales
Sales.
times 100%. Okay,
Yes,
so
sir.
net profit before tax is how much? It's 8,000. Check, it is in there. That one they brought it. It is there straight away. Have you seen it?
Okay. Okay.
8,000 divided by sales. Sales is what? 125,000
125.
times 100%. So what do we have?
Sir, 6.4.
6.4%.
Yes, sir.
Have you seen it? So we've answered the first one. So the first one including, you see, the first one, they said including what? Subsidiary. Yeah, this is what they said. So when you look at the question, including the what? The subsidiary, it say calculate the what? Equivalent ratio for Madina Limited for 2018, including the results of what? Abu Abu Limited acquired during the year. So that means including the subsidiary. Now excluding the effect of purchase of Abu Abu, that means excluding the subsidiary. Please, have you seen it?
Yes, sir.
The second one say that excluding the what? The subsidiary.
The first one is including.
The first one, the second one is what? Excluding it.
Excluding.
So how do we do that? So you come there. So the second one, excluding subsidiary. Excluding subsidiary. So what do you do? So here first, you pick the profit and loss for the year ended 30th what? 30th what? Accounting year, man. 30th September.
September
Uh-huh.
28.
Now, then you pick the what? First one, you pick the what? Their profit. Their revenue, sorry. You pick the revenue. The revenue is how much?
The revenue. Revenue.
This is Madina. I put it well for you to understand why you're excluding it.
Thank you.
So you have what? Madina, you have what? Revenue is how much?
Revenue is
125,000. Please, let's make fast. So 125,000. Then we less Abu, which is what? The subsidiary. Go to their here is what? 35,000. So what do you have? You less it. What do you have?
90, sir.
90,000. And the next one is what?
The next one.
The next item is what?
Cost of sales.
Cost of sales. Parent is how much?
Parent is 25,000.
Parent is 100,000.
Oh, okay, 100,000.
Subsidiary is how much?
Subsidiary is
20,000. When you less it, what do you have? You have 80,000. Yeah. When you less from this, what do you have?
10.
Is this 190,000 or 900,000?
90,000.
90,000.
It's 125 minus
okay.
35,000.
Okay, so that's what. So this becomes your gross profit, right? Okay. So the next item is what?
The next gross, that is so we have operating expenses.
Operating expenses. So operating expenses, parent is how much? Parent
is giving me
13,000.
Yes, sir.
Subsidiary is how much?
Operating expenses, subsidiary is giving me 15,000.
Subsidiary is 15,000. Subsidiary is 4,000.
4,000.
So when you less, what do you have?
You get
9,000. So the next item is what?
Finance costs.
Finance costs. The subsidiary doesn't have. Finance cost is how much?
4,000 here. Parent.
Yeah. So here we are for
nil.
Yeah, here will be nil, and here will be how much?
4,000. Still 4,000.
That one will be 4,000.
Yes, sir.
So 10,000. So here is what? 4,000. When you add it, or what do you have? Do you understand?
Wait, this is 10,000. It will be 19 plus 23.
No, so you will less it. So this one operating profit
So you get this is 13 minus, so you get minus 3,000.
under 3,000, which is loss. So because for that you cannot calculate tax. You know that.
Yes.
When that happens, you can't calculate tax. You are coming to calculate your what? Your ROCE. What do you have? You have profit before taxes, which is how much?
That is 3,000 minus 3,000.
Profit before tax. Net profit before tax.
So we are going to add. We are going to add operating profit plus this thing. So we get 1,000. We had loss at the operating side.
So profit before interest and tax.
Correct.
All divided by what? By sales. So what is the profit before interest and tax?
So it will give me.
So profit before interest and tax is how much?
4,000 minus 3,000. We have to add them.
Oh, okay. So the profit before interest and tax is negative 3, right?
Yes, sir.
Okay. So that gives you what? 3,000. Then we add back what? We add back what? Finance cost.
4,000.
4,000.
Yes, sir.
So how much would that be?
It will be 1,000, sir.
All divided by sales. Sales is how much?
90,000, sir.
90,000 times 100%.
Yes.
Okay. What do you have?
Yes, sir. 1.1.
1.1%.
Yes, sir.
Okay. So let's go to the next one. Next one is what? Gross profit margin, which is what? Gross profit over what? Over sales. So how much is the gross profit?
The gross profit is,
as we calculated here, the
10,
gross profit is how
10,
much? 10,000. Okay, so you have what? 10,000 all divided by what? By sales. Sales is how much?
90,000.
90,000 as we calculated times 100. What do you have?
11%.
11%.
Yeah, 11.1%.
Okay, 11%. Okay, so the third one is what? Net profit margin. Okay, so that is what? Net profit before tax. All divided by what? By sales. What do you have? Net profit before tax is how much?
Are we having net profit? Is it not new?
No, it's negative. It's into bracket 3,000. All divided by sales. Sales is how much?
90.
90,000 times 100%.
Minus 3.3%.
Okay, 3.3%. But I think the ROCE, are you sure we did it correct? We didn't do it correct. This one should be asset. It's not the
total. Okay.
and also what? Current liability.
Current liability. Yes.
Okay, your current liability is how much? As we did up there, what did we get?
The old one that we did. Okay.
It's how much?
We had 129,000 minus 22,000.
Okay. How much is it?
107,000.
So what do you have?
Okay, 0.94%. So you are right.
Like this, right?
Yes.
What can you say about this? You understand? So when you are done doing this, then you come and do your analysis. That's all. Because the subsidiary didn't give us balance sheet for subsidiary. Or do you have balance sheet for subsidiary?
No, we don't have balance sheet for subsidiary.
Okay. Okay. So when you are done there, you come and do the analysis. So I've already given you the clue how to go about the analysis. So you just compare year on year. You understand? So when you come here, maybe the first one, maybe you come and do what analysis. So you come see maybe the first year, then you state it 2018. They've given you, they've already calculated the it for you here. I'll be saying it 2017, 2018. So 2017 ROCE was how much?
2017 ROCE was 7.1%.
7.1%. And 2018, when you calculated is how much?
2018
11.2.
11.2.
Then you come to 3. Which one is this? Gross
profit, sir.
Gross profit 2017, it was how much?
2017
16.7. And the one we calculated is how much? 20%.
The one 20%.
And then 3, net profit margin 2017 is 4.4%. And the one we calculated is how much? 6.4.
The one we got 6.4.
Right. Okay. So this is when it is what? Including the what? The subsidiary. And so your analysis, what are you going to right? I've given you the clue. So all you have to say that roses. So I've given you how to write it, right? This one, I'm just doing the raw calculation analysis. Please, have you seen it? You know
Yes,
the
sir.
format. You introduce you introduce whatever you are doing and all that, right? Okay, then you
Yes, sir.
write about the report. So here, what do you do? Or let me add this one before we can do the analysis. So this is excluding subsidiary. You have first one, Rose. Rose is how much?
First one, Rose.
Rose.
That is, we had 0.94%.
Okay, so excluding for the same year. Okay, so 2018. So you have here 2018, 2017. Now 2017, they are 7.1%. 2018 is
0.9%.
7.1%, 0.94%. And the second one is what? Gross profit.
Gross profit is giving me 11%.
This one is what? 16.7%.
7.
And then this one gives you how much?
11%, sir.
11%. Then net profit margin. This one
3.3.
3.3%. And then this one gives you how much?
4.4, sir.
4.4%. What can you say? So now you are coming to do your analysis. So you've listed all these things. So what you will do is that you will say Rose has improved from how much? What here? You start from the top there when you consolidated from 7.1% to when? To how much?
From 7.1 to
11.2% after what? After acquisition of what? Of Aboabo Limited. You can say that this improvement could be as what? As a result of what? As a result of what? Of acquisition. You understand? Now, excluding Aboabo Limited, gross of Medina alone. Have you seen that? Medina Limited. And when we did it, how much is it?
Excluding Medina came down.
It came what? 0.9%.
9%.
It's what? 0.94%. Which means the parent was not doing well in terms of what? Of returns on its what? Investments. Until what? Until the subsidiary is what? Is acquired. Goes to Asa. Then you'll pick the next one. The next one is what? Gross profit margin. Gross profit margin as at 2018 was how much? Please check for me.
2018
was
16.7%.
Sorry, was what? No, 2018 was how much? Check for me again.
2018 was 20%.
Was what?
So the
20%. Watch here. 20% was what? An improvement. Which was an improvement from 2017, which was how much?
16.7.
16.7%. However, when it is excluded, the subsidiary was excluded. The gross profit margin is now how much? Check for me, please.
11 points. 11%.
11 point what?
11%.
11.0%. You understand?
Yes, sir.
Okay, so when you remove the subsidiary, it has now reduced what? 11 So have you seen that? So you can suggest that this could be as a result of what? Poor management of what? Cost, direct cost management, or inflation, or maybe competitive what? Price pressure. From what? From the market. Okay. Okay. That's Then you come to the last one is what?
Net profit margin.
Net profit margin. Saw an increase from how much? 2020,
Yeah.
2017 is how much?
2017 is 4.4.
4.4%
4.4.
to 6.4% for the year 2017 and what? 2018 respectively. Then you say this will be as a what? As a result of what? Good management of what? Operating expenses. However, when the what? When the subsidiary was excluded, Medina Limited what? Recorded a negative what? Profit, which is what? 3,000, right? Percentage is how much? Negative 3.3%. Is that not the case?
Yes, sir. Yes.
So this is how you do the analysis. So this could be as a result poor management of what? Operating expenses. Poor management of what? Operating expenses and what? And other operating costs. Full stop. That's all. Please, you understand?
Yes, sir.
So that is all about the reporting. So this is the body that you write in what? In your report. Are you with me? Okay. So that is all. That is it about this question.
No, sir. I'm grateful.
Thank you very much. In conclusion, so you conclude. What do you say? You say that the overall performance of the parent, which is what? Medina Limited, in 2018 is very much concerning. Why? It is the acquisition of Abu Abu Limited that has significantly, see, right, that has significantly contributed or improved. That's significantly what? Improve the what? The three key areas. However, the core business, Medina Limited, is not profitable since the business of Medina Limited is not generating higher revenue. There is a risk of loan of 50 million acquired in what? In acquisition of the subsidiary. So this is how we can conclude. All right, so let us look at the last item. They said that analyze the cash position of Manila Limited as of September 2018. So let's do what? Cash position analysis. So we are done with analysis. So let us go into the question. It says that analyze the cash position of Manila Limited as at 30th September 2018. All right. So now, first one, this is what I'm looking at. I'm looking at acquisition of, I'm looking at acquisition of what? Awabo Limited. Right? Okay. What can I say about that? You see, the acquisition of Awabo net asset for 50 million was financed entirely by what? Was financed at what? At 8% loan note. Right? Okay. What happened? So with this, okay, let me put it there. So this is non-cash what transaction. The annual interest payment burden of how much? Which is 50 million times 8%. I guess you how much? Which is 4,000. Create what? It will create an ongoing cash outflow, right? Because this is also another burden to the company. So that is one. So two, what can you see? I can also see significant what? Capital expenditure. Right? Now let's look at what I mean by significant expenditure. Check. Look at the balance sheet or financial position of the company. Check. In 2017, we were having 45,000, and now it has ballooned to how much? 100 and what? 5,000, which is what? A rise of what? An amount of, I think, 60,000 thereabout. You understand? So what does it mean? So you say that there has been what? Significant what? Expenditure on what? On capital asset from how much? 45,000 to what? 105,000. Where how much did we buy the subsidiary? Where 50 million of it relates to who? Relates to the acquisition of subsidiary. Right. However, additional assets acquired in the core business could directly have what? Consume cash resources. See, we invested so much in asset acquisition, which will deplete the cash available. Okay, let us also look at something here. Look at trade receivables. Look at trade receivables. Trade receivables from 4,000 to 6,500. Inventory from 7,000 to, then when you look at this, then you just oppose it with the current liability. Check the current liability. Look at bank payable from 6,000 to 11,000. So here you can clearly see that the trade payable has increased far more than what? Trade receivables, right? So we can equally talk about that. All right, so basically this is what you can say about that. Now you can also talk about working capital. Now the working capital, what can you see? I can say that the working capital. Working capital has what has deteriorated. Why? Let's look at the receivables. Check the receivables. How about your receivables? The receivables is from how much? From 4,000 to how much? 6,500. Right. And then inventory is how much? Inventory from where? From 7,500 to 12,500. Whilst at check the payable. While the what? Whilst payable also rose from where? 6,500 to 11,500. The net impact on working capital is negative. Is what? It's negative. You understand? You understand? So that is so this ties up additional cash in operation. So you have to when you look at the statement of financial position, anything that affect the cash, then you talk about it. So that is it about this very question. All right. So God willing, we shall meet for another class. Thank you very much.